Welcome to the deep dive. Glad you could join us. Today we're really digging into something important in the bond world, spread measures.
That's right.
We're aiming to unpack four key ones: G-spread, I-spread, Z-spread, and OAS. Now these might sound a bit complex, maybe a little intimidating, but they're essential tools. They help you see beyond just the headline yield of a bond. Think of it like this. Just knowing the yield is like knowing a car's top speed. But these spreads tell you about its handling, its engine quirks, the stuff that really matters for performance and risk.
Exactly. Because that yield number, the yield to maturity, it doesn't exist in a vacuum. It doesn't tell the whole story.
Right.
Spreads help us compare a bond to a benchmark, like government bonds or swap rates. They give you that critical context you need to actually make an informed decision. Are you really getting paid enough for the risk you're taking? That's the question spreads help answer.
Okay, let's get into it then. We're starting with G-spread and I-spread. What exactly are these, and why do we even need them? Do we already have the YTM?
Good question. Let's start with the G spread. The G stands for government. So conceptually, it's pretty straightforward. It's the yield spread of your bond compared to the government bond yield curve, right at that bond's specific maturity.
Okay.
So you take the bond's yield to maturity, the YTM, and you subtract the government yield for that same maturity. Now, usually you have to estimate that government yield.
Because government bonds don't trade at every single maturity date.
Oh, precisely. So you use linear interpolation. If your bond matures in, say, 7.5 years, you look at the yields of the 7-year and 8-year government bonds, and you basically draw a straight line between them to estimate the 7.5-year yield.
Okay, makes sense, like connecting the dots.
Exactly. And the main use case for G-spread is when government bonds are seen as the risk-free benchmark in that particular currency. It's quick, it's simple to calculate.
I sense a but.
Well, the but is its simplicity is also its weakness. It's just comparing one point, the YTM, to another estimated point on the curve. It completely ignores the timing and size of all the other cash flows, like the coupon payments before maturity.
So a quick glance, but maybe not the full picture.
Pretty much. The formula is basically YTM of the bond minus the interpolated government yield at maturity T.
Got it. So it's a quick comparison to the, let's say, safest benchmark. What about the I-spread then? Is that similar?
Very similar in concept, yes. The I in I spread stands for interpolated, though it's often called the swap spread too. Here, instead of the government curve, you're comparing the bond's YTM to the interest rate swap curve at the same maturity.
Okay, why swaps? Why not just stick with government bonds?
Well, in many markets, particularly in euros and sterling, and actually for a lot of USD desks too, the swap curve is considered a better reflection of sort of interbank funding rates and general market conditions. It's often seen as a more market-based benchmark than government bonds, which can sometimes be affected by, specific supply-demand dynamics or flight-to-quality effects.
Interesting. So it's about which benchmark the market itself prefers to use.
Exactly. And just like the G-spread, you're still linearly interpolating the swap rates to match the bond's exact maturity. And crucially, it's also based on the yield to maturity.
Right. So the formula is similar. YTM of the bond minus the interpolated swap rate at maturity T.
You got it.
Okay, this raises an important question, though. You've said both G-spread and I-spread rely on YTM. What are the pitfalls or limitations of using these YTM-based spreads? Are we potentially missing something significant?
That's the key issue, really. Because they are YTM-based, they're quick, yes, but they can be crude. YTM itself is a simplification, right? It assumes you reinvest all your coupons at that same yield, which rarely happens. And it means these spreads don't fully account for the shape of the yield curve. If the curve is really steep or inverted, that can distort the comparison. Also, if you have two bonds with the same maturity but very different coupon structures, say one pays a high coupon, one pays a low coupon, their G or I spreads might look similar, but their actual risk profiles could be different because the timing of their cash flows varies. These simple spreads don't capture that nuance.
Okay, that makes sense. Could you maybe walk us through a quick example to make it more concrete?
Sure. Let's use that hypothetical 5-year corporate bond. Say its YTM is 5.20%. Now let's find the G-spread. If the 5-year government bond yield, let's assume there's one right at 5 years, so no interpolation needed for simplicity here, is 4.70%.
Okay.
Then the G-spread is just 5.20% minus 4.70%, which is 0.50%, or 50 basis points. Remember, a basis point is just 1/100th of a percent.
Right, 50 BPS. So it yields 0.5% more than the government bond.
Correct. Now, for the I spread. Let's say the 5-year interest rate swap rate is 4.85%. Then the I spread is 5.20% minus 4.85%. That gives us 0.35%, or 35 basis points.
So 35 BPs over the swap rate. Got it. It gives you a quick relative value check against different benchmarks.
Precisely. Tells you the extra yield pickup compared to those reference points.
Okay, here's where it seems to get really interesting. What if a bond's cash flows aren't just simple coupons and principal? Or what if we just want a more precise measure than these YTM-based ones? That brings us to the Z-spread, right?
Exactly. The Z-spread, or zero volatility spread, tackles some of those limitations we just talked about. It's a much more sophisticated measure.
How does it work?
Okay, instead of just comparing the YTM, the Z-spread is a constant spread that you add to every single point along the entire benchmark zero coupon yield curve. Usually that's the government zero curve.
Wait, the zero coupon curve, not the regular government bond curve.
Right. The zero coupon curve, or spot curve, represents the theoretical yield for pure discount bonds, bonds that make only one payment at maturity with no coupons. It gives you a pure discount rate for each specific point in time.
Okay, so you add this constant Z-spread to every point on that zero curve. Why?
You add that spread, Z, such that when you discount all of the bond's promised cash flows, every single coupon payment, plus the principal repayment using this adjusted zero curve, zero rate plus Z for each cash flow date, the sum of their present values equals the bond's current market price.
Ah, okay. So it's not just looking at the end of maturity like G and I spreads, it's making sure the price matches up when you account for every payment discounted properly using the whole curve plus this extra bit Z.
Exactly right. It respects the timing and size of all fixed cash flows and the entire shape of the benchmark curve. That makes it a much more accurate measure of the bond's spread over the benchmark curve, assuming the cash flows are fixed.
Assuming fixed cash flows.
Yeah.
That sounds important.
It's absolutely critical. The Z-spread is only valid for bonds with fixed, predictable cash flows. Think standard corporate bonds, government bonds. It is not valid for bonds with embedded options.
Why not?
Because if a bond is, say, callable, the issuer might redeem it early if rates fall. Or if it's putable, you might sell it back early if rates rise. The cash flows are no longer certain. They depend on future interest rates. The Z-spread calculation fundamentally assumes those cash flows are locked in.
Gotcha. So Z-spread is great for plain vanilla bonds, gives a curve-consistent spread, but breaks down if there are options involved.
Precisely. It gives you a more accurate picture than G or I spread for those fixed cash flow bonds.
And going back to our example, does that 5-year corporate bond look different with the Z-spread?
It usually does. So for that same 5-year bond with the 5.2 Pursue YTM, if we actually discounted its full stream of semi-annual coupons and principal using the government zero coupon curve, we might find we need to add, say, 58 basis points to that entire curve to make the present value match the market price.
So Z-spread is 58 BPs in this case, higher than the 50 BP G-spread we calculated earlier.
Often, yes. Because it properly accounts for the curve shape and the timing of all cash flows, it usually gives a slightly different and generally more accurate number than the simpler YTM-based spreads, especially if the yield curve isn't flat.
Okay, that Z-spread seems powerful for standard bonds, but you flag that huge caveat, not valid for bonds with embedded options. So what do we do when a bond has those features, like a call option for the issuer or a put option for the investor? How do we figure out the spread then?
Right, that's where we need the big guns. The option-adjusted spread, or OAS. This is designed specifically for bonds where optionality is a factor.
Option adjusted. So it adjusts for the option.
Exactly. The OAS is the spread over the benchmark curve. Again, usually the risk-free zero curve or maybe a swap curve that you'd earn if interest rate volatility were zero, effectively. But the key idea is that it's calculated after the value of the embedded option has been stripped out or accounted for.
How do you strip out the value of an option? That sounds complicated.
It is. It requires using valuation models, typically things like binomial interest rate trees or Monte Carlo simulations. These models project thousands of possible future interest rate paths. For each path, the model figures out if the option would be exercised, like would the issuer call the bond back, and determines the resulting cash flows on that path. Then it calculates a present value along each path, averages them out, and finds the constant spread, the OAS, that needs to be added to the benchmark curve in the model to make the calculated average present value equal the bond's current market price.
Wow. Okay, so it's simulating all sorts of futures to figure out the expected impact of the option and then finding the underlying spread without that option effect.
That's a great way to put it. It's isolating the spread component that compensates you purely for credit risk and liquidity risk after accounting for the impact of the embedded option.
So there must be a relationship between Z-spread and OAS then.
There is, and it's really important conceptually, roughly speaking.
Yeah.
OAS is approximately equal to the Z-spread minus the cost of the option, usually expressed in basis points per year.
Okay, Z-spread minus option cost. Let's
Yep.
unpack that. What does it mean for, say, a callable bond?
Right. A callable bond gives the issuer the right to buy the bond back early, typically when interest rates fall. That option benefits the issuer, not you, the investor. It's a risk for you.
Hmm.
So that call option has a positive cost to the investor or value to the issuer. Therefore, for a callable bond, the OAS will be less than the Z-spread. The difference, Z-spread minus OAS, represents the market's implied cost of that call option embedded in the bond. You're getting a lower spread OAS because part of the bond's apparent yield, reflected in the Z-spread, is actually compensation you lose due to the issuer's call rate.
Okay, so OAS Z-spread for callable bonds. What about putable bonds, where I have the option to sell it back?
Good question. A putable bond gives the investor the right to sell the bond back to the issuer early, usually if rates rise significantly. This option benefits you.
Right, protects me from rising rates to some extent.
Exactly. So that put option has value to the investor. It makes the bond more attractive. Therefore, for a putable bond, the OAS will generally be greater than the Z-spread. The difference, OAS minus Z-spread, or think of it as Z-spread plus the option's value to you, reflects the value of that put option you hold. You effectively get a higher spread compensation because of that valuable feature.
Fascinating. It sounds like OAS is really trying to get to the true underlying spread, stripping away those option distortions. How does our little 5-year bond example play out here?
Okay, let's say our 5-year corporate bond with its Z-spread of 58 basis points is actually callable.
Yeah.
Then we run it through one of these fancy option valuation models using current market volatility assumptions and so on.
Right.
The model might tell us that the OAS is, say, 40 basis points.
Okay, so OAS is 40 BP, Z-spread was 58 BP.
Correct. Since OAS is Z-spread option cost, we can estimate the option cost. It's roughly the Z-spread minus the OAS. 58 BP minus 40 BP equals 18 basis points.
So the market is implicitly valuing the issuer's call option at about 18 basis points per year in spread terms.
That's the interpretation, yes. That 18 BPs is the price you're paying in terms of lower spread for the risk that the bond gets called away from you.
This raises a pretty important point, though. You said OAS relies on models and volatility inputs. What does that mean for its accuracy? Can we always trust the OAS number we see?
That is the Achilles heel, absolutely. The quality of the OAS number is only as good as the model used to calculate it, and critically, the inputs you feed into that model, especially interest rate volatility assumptions.
So different models or different volatility guesses could give different OAS numbers.
Definitely. Garbage in, garbage out, as they say. For relatively simple callable bonds, the models might be fairly standard, but for really complex stuff like mortgage-backed securities where homeowner prepayment behavior is incredibly difficult to model, the OAS can vary significantly depending on the prepayment model used, the volatility assumptions, the interest rate model itself. It becomes much more of an estimate, and you need to understand the assumptions behind the number. It's not a single, universally agreed upon truth like a G-spread might appear to be, even if the G-spread is cruder.
Okay, that's a really important caveat. Model risk is real here.
Very real.
So let's tie this all together for the listener. We've journeyed from the simple G and I spreads through the more precise Z spread for fixed flows to the complex model-driven OAS for bonds with options. What does this all mean for you when you're looking at bonds? How do you use this toolkit?
Right. The core takeaway is that these different spreads aren't competing measures where one is always best. They offer different lenses to view a bond's value and risk. You need to know which lens to use when.
So a quick recap.
Sure. G-spread and I-spread. Use them for quick YTM-based comparisons. Good for a first look, understanding the ballpark relative value against standard benchmarks. But remember, their limitations, they're crude. Ignore cash flow timing and curve shape.
Okay.
Z spread. This is your tool for fixed cash flow bonds when you need more precision. It's curve consistent, respects all the cash flows, but remember, its big limitation, do not use it if the bond has embedded options.
Got it. Fixed flows only.
And finally, OAS. This is the one you must look at for any bond with embedded options, callable, putable, MBS, you name it. It adjusts for the option's value to give you a better estimate of the underlying pure spread. But, and it's a big but, always be aware that its quality depends heavily on the model and the inputs used.
Okay, that's a clear framework.
Yeah.
Any final practical tips?
One practical thing, always double-check how I spread is defined by your data source or on your trading desk. Is it spread to the swap curve, or sometimes less commonly now, is it interpolated against the government curve? Conventions can vary, so just be clear what benchmark you're actually looking at.
Good point. Ultimately, understanding these different spreads helps you do your homework better. You can compare bonds much more accurately, potentially spot mispricings that others miss if they only look at YTM, and really assess if you're getting adequate compensation for the specific risks you're taking on credit risk, liquidity risk, and option risk. It helps whether you're just learning or you're walking into an investment committee meeting, and it's about looking under the hood.
Fantastic. So we've really unpacked the G-spread, I-spread, Z-spread, and OAS.
Yeah.
We went from those quick glances to the really detailed, model-adjusted views. It shows that, yeah, finance can seem complex, but breaking these concepts down gives you a much, much clearer perspective on what you're actually looking at with a bond investment. It's not just about the yield number.
Absolutely. And maybe this leaves you, the listener, with something to think about. How does knowing about these different ways to measure spread change how you might look at a bond next time? Does it make you ask more questions beyond just what's the yield? Does it change how you think about the price you're willing to pay?
A great question to ponder. Thanks so much for walking us through that. And thank you all for joining us on this deep dive. Keep exploring, keep learning, and we'll catch you next time.